analysis.
Is it not working?
All right. On the agenda today, we have motivation, why this is useful, our project roadmap, and current progress. So, you might ask yourself, what is realized volatility versus implied volatility? Realized volatility is essentially backward looking, and implied volatility is forward looking. And the motivation behind our project is the difference between implied volatility and realized volatility creates mispricing in options. And the objective for our project is to build a model that estimates future realized volatility, which is far better than implied volatility. And like all projects involving data, we had to collect and process data. And we had to build statistical tools to validate the robustness of models and then deep dive into the literature and find out what models actually forecast intraday realized volatility, what pricing option contracts do we have, and build trading strategies. And of course, like any other project that involves data, we had to backtest and validate our results. So we started off with data from 2000 to 2021. And after robust testing and a lot of exploration, discovered that most of the data we had from 2000 to 2011 wasn't really giving us a good result, so we had to eliminate it. And you might ask, why wasn't it giving us a good result, right? Mostly, the major concerns with the models we've been trying to build is looking at realized volatility. How much data do we have that actually fits well with our model without introducing bias and any of the other factors that might make it unrealistic and unreasonable? So we've selected data from 2012 to 2021. And my colleagues will deep dive into the process, model validation, volatility, and try to stay awake for this part, because if you don't ask questions, we'll ask questions. Thank you.
All right. Thank you so much, Tanya. I hope you can hear my voice. Just give a thumbs up.
Yes, we can hear you.
All right, great. So let's talk about the analysis which we have started. Let's talk about the returns analysis. Could you please go to the next slide, please? All right. So we have grouped our data into 2-hour data, 2-hour time frame. So in every 2 hour, we kept a threshold of 100. So this means that for every 2 hour, there are 120-minute, 1-minute data. So at least 100 points should be available for each 2-hour time frame. Hence, we consider them as green, if not the red. So if you see the graph, the green ones are the eligible ones which are passing through the 100 threshold, and the red ones are the ones which are not passing through the 100 threshold. Most of the red dots are between the 5 p.m. of Friday and till the 5 p.m. of Sunday, because that's when it's the Euro USD is not being traded. Next slide, please. And if you see, this plot represents the returns over the time 2012 till 2022. And this returns hovers between +2% and -2%. Next slide, please. Let's talk about the returns distribution. This is having mean close to 0 and the standard deviation of 0.14 with minimum -2.61 and max of 1.79. And the skew is -0.09 with kurtosis of 16.18. This is just the returns distribution. Next slide, please. Let's talk about the volatility analysis. Let's see how we have calculated the annualized realized volatility. Next slide, please. All right. So this is the formula which we have used. Let me explain in a bit. I think there's the inverse factor which is missing. Okay, let me explain. The first root, under the root we have the square of the log returns. multiplied by the annualized factor, which is basically we have taken the 2-hour data frame, 2-hour time frame. So that is basically 365 into 24 into 60, 365 days into 24 hours into 60 minutes by 120 minutes, which is our 2-hour time frame. So this gives us the close to close 2-hour realized volatility numbers. Next slide, please.
Kurtosis of the volatility distribution of Euro USD. 2 hours volatility.
So we have prepared our data, filtered our data, and now we want to perform analysis on this data. And we were looking for patterns, some signals that this data can possibly have. So we first approach we did, we look at this autocorrelation graph. We grouped our data into 100 periods, 100 previous 2-hour volatility periods. And as you can see, it's very periodic. And each 12, so since we are considering 2-hour volatility, the 12th leg is the previous day. But it is like it is a common thing because New York Open is New York Open every day. So you can expect a correlation. But you can what you can see here is for the lag one, you can also get you are also getting a pretty high correlation as well. So what I'm trying to motivate is that the previous period is also can be a good predictor of the realized volatility. Next slide. So again, we tried to build this simple model just using previous period volatility. And this is the fit that we're getting. It's not too good, not too bad, but still you need to consider that we are just using previous period volatility to predict the volatility of next period. And this is the distribution of log ratio error looks like. The reason we are considering log ratios is because we are looking at percentage errors, because the idea behind this is that the magnitude of the error is actually depend on the magnitude of the volatility, and that's why it's a good idea to consider percentage error rather than the absolute error. And again, we'll see in the next slide that we are trying to minimize this error. And previous slide. So as you can see, the distribution of error, it is a much tighter variance when you use the close-to-close approach, the previous formula that Sai talked about. It gives a much tighter variance and yeah. So yeah, we build our model using just previous period volatility, and now we want to build statistical tools and empirical analysis on this model and see how stable it is throughout the whole period. So again, we use the filtering technique that we use for the data, and we set some certain threshold. Okay, if we have certain number of error counts, we're going to consider only that data. And so we set this threshold to 100. So if we have a log ratio count of above 100, we're going to check stability and error only for that data. And as you can see, the standard deviation, it is almost stable for throughout the whole data. And as I have talked about, you get a much tighter variance if you use a log ratio approach. Yeah. Then Estefano is going to talk about the model that we're trying to achieve.
This is not our model. It might look complicated, but this is Quant's model. He's a very famous researcher, Quant, that once worked in Bloomberg. But anyway, the point of this model is to model volatility using two parameters, right? You have your past volatility, and then you have your past returns. Using these two, you can model volatility as good as the Heston model. And our motivation to model volatility is based on this model, right? So R1 represents the returns, R2 is the squared variance or the standard deviation. You put that into that equation, and you can get your volatility. And when I'm talking about past returns and past volatility, it's you're considering the short-term and long-term memory. Okay, so you're not just taking the past return and volatility. So our goal was to build this from ground up. We wanted to understand how each of the things came together. So we started with an autocorrelation function. right? So what this tells us is how correlated is our past volatility, for this case, our past volatility to our volatility with the current volatility that we have. So lag one basically tells us, okay, the previous period volatility is a good predictor of right now volatility. And basically, you can see that there is some kind of seasonality, and there is a short-term and long-term memory in this plot. So as of now, we're just building a very simple model of Quant, and we're just taking two volatilities. Okay, let's start with taking the previous 2-hour volatility, and then let's take the previous day volatility, right? And weigh them with some alpha parameter. Let's optimize that, and let's predict volatility. And that's exactly what we did. And using this very, very simple volatility model, our results is kind of fair, I would say. So now we have our model, a very simple model. How did we implement this model? So as I said, we wanted to optimize alpha. So what we did was we grouped each 2-hour volatility predictions that we had into monthly. So we trained the optimal alpha that would minimize our prediction error on, let's say, January over there. And then we tested that alpha on the next month, February. And then we did that rolling to see the stability of this model. That's one of the testing tools that we have. Stability plays a big, important role. And the optimization method that we used was a Newton-Raphson type of algorithm. So yeah, so this is what our plots look like. We have a prediction error of 33%. That is big. We understand that, but given how simple the model is, it shows that these two features plays a big role. And yeah, so moving forward, we plan to actually execute and build up Quant's model, and look forward to that. Thank you. Yes.
So as you were looking at the data, did you explore any properties of volatility reversion to the mean?
Yes. I mean, volatility always reverses back to the mean.
Yeah, I asked because the equations of autocorrelation don't take into account that pullback to the mean. And I'm wondering how that would change your results if you looked at it, thinking of something along the lines of a Vazicek or Ornstein-Uhlenbeck process.
The autocorrelation was just to look at the signals that we can get from the data. But as you're asking, we haven't checked anything about the mean reverting property. But the model we're trying to achieve, the Professor Guyon's work, it actually shows that there is a mathematical proof for that it is a mean reverting property if you use that model, just using previous returns. Yeah.
Did you have a look at volatility swap markets, volatility swap data?
No. And you might be asking, why are we doing Euro USD when trying to predict volatility or model volatility? It's because of the data that was available to us. We collected 1-minute data over 12 years. Imagine how big that data is, right? And trying to prepare that data and fix that took a lot of time. So we're only right now using Euro USD 1-minute price data to build this volatility. So, but I would assume if you have that data with the 1 minute, you could just plug it into here, and you can get that volatility, the 2-hour volatility, and then use that into the model that we will be building. Yes. So the answer is we didn't look into the swap data because it's very hard to get that high frequency data.
That you use 365 days instead of trading days.
Yes. So FX has longer, oh, like the trading days for FX is longer compared to like the usual stock market. So if you go back over there, actually. So 252 is used for stock prices, right? To get to analyze stock volatility for stock. But FX has a longer trading window. So that's why we use 365, assuming it would be more accurate measure. In this case, this is for stock. It's not reflective of the 2-hour volatility, but it would be 360 divided by 360 converted to minutes, 365 days converted to minutes, and then divided by 120 because we have 2 hours.